Welcome. Today, we are going to explore how to use the volume indicator in trading. This is a simple but very powerful tool that can help you make better trading decisions. By the end of our time together, you will understand how to read the volume indicator. You will know how to apply it to your trades. And most importantly, you will improve your overall trading strategy. Have you ever wondered how traders can tell if a price movement is real or just a fake out? One of the most powerful tools they use is the volume indicator. To kick things off, what is the volume indicator? The volume indicator shows how many shares or contracts were traded during a specific period. It gives you a way to measure the activity or interest in a particular stock or asset. Volume is really important because it can confirm trends, reveal potential reversals, and help you spot breakouts. It can also be used alongside chart patterns to better understand price behavior. Chart patterns such as double tops, head and shoulders, triangles, flags, pennants, and wedges can be more accurately interpreted when combined with volume analysis. Let us start with the double top pattern. The double top pattern occurs when the price reaches a high point, pulls back, and then rises to a similar high before reversing. This pattern is stronger when the volume on the second peak is lower than the first peak, indicating reduced buying interest and a potential reversal. A similar logic applies to the double bottom pattern, where lower volume at the second bottom indicates reduced selling pressure, suggesting a potential reversal to the upside. Next, consider the head and shoulders pattern. A head and shoulders pattern consists of a peak left shoulder, followed by a higher peak head, and then another lower peak right shoulder. This pattern becomes more reliable if the volume is decreasing during the formation of the second peak head and the right shoulder, signaling weakening buying interest. Additionally, an increase in volume when the neckline is broken adds further confirmation to the validity of the pattern. Triangle patterns are also key to understand. There are ascending, descending, and symmetrical triangles. In an ascending triangle, volume often contracts during the consolidation phase and expands significantly when the price breaks above resistance, confirming a bullish breakout. In descending triangles, volume behaves similarly, but the breakout is typically downward. Symmetrical triangles can break out in either direction, and volume plays a crucial role in confirming the breakout direction. A surge in volume accompanying the breakout makes it much more trustworthy. Flags and pennants are continuation patterns that usually form after a strong price movement. They represent short-term consolidation before the trend continues in its original direction. Flags appear as small rectangular channels sloping against the prevailing trend, while pennants are small symmetrical triangles. The key with flags and pennants is that volume typically decreases during the formation of these patterns, followed by a sharp increase in volume when the price breaks out, confirming the continuation of the trend. Wedges are another pattern that can signal either reversals or continuations, depending on their context. Rising wedges tend to have declining volume as the price climbs within a narrowing range, often indicating a bearish reversal. Falling wedges, on the other hand, generally have declining volume and suggest a bullish reversal when volume increases on the breakout. All of these chart patterns can be more accurately interpreted when combined with volume analysis. Volume helps validate the strength of these patterns and provides insights into whether the price action is supported by market participants. For instance, if a breakout occurs but volume is low, the breakout may not be reliable. Conversely, strong volume during a breakout indicates solid participation, and increases the probability of a successful move. All of this makes the volume indicator an essential tool for traders who want to understand the strength behind price movements. Now you might be wondering, how do you actually read the volume indicator? When you see an increase in volume, it means more people are trading that asset. When there is high volume during a price move, it means strong interest from traders. On the other hand, low volume can suggest weak momentum. If you see a price rise along with high volume, that is usually a strong signal that there is real interest behind the move. If price rises but volume stays low, the move might not be as solid and could easily reverse. It is really important to understand the difference between high volume and low volume. High volume confirms the strength of a price move. It shows that there is a lot of interest whether the price is moving up or down. Low volume signals that there may be indecision or a lack of interest. This means that the price move may not be sustainable. Next, we are going to talk about how volume helps confirm trends. In an uptrend, if you see volume rising, it is a good sign that the upward price movement is supported by strong buying interest. This adds confidence that the trend will continue. In a downtrend, rising volume shows that sellers are in control and that the downward movement is likely to continue. High volume during a price drop often means that the sellers are serious and the bearish trend is here to stay. But what happens if volume starts to decline during a trend? When volume drops while a trend is still in place, it might indicate that the trend is getting weaker. For example, if a stock has been going up, but the volume starts to decline, it could mean that the rally is losing steam. This could mean a reversal is on the way. Let us talk about using volume to identify breakouts. A breakout is when the price moves beyond a key level of support or resistance, and volume is critical to confirm that breakout. If a breakout happens on high volume, it is more likely to be a real move. This means there is strong participation from either buyers or sellers. When analyzing breakouts, it is important to look for a surge in volume that accompanies the price movement. This shows that there is real market enthusiasm behind the breakout, making it more likely to continue in the breakout direction. In addition to volume confirmation, it is also useful to recognize certain chart patterns that often indicate potential breakouts. For example, ascending triangles, descending triangles, and symmetrical triangles often precede breakouts. In an ascending triangle, the price forms higher lows, pressing up against a resistance level. If the breakout occurs with high volume, it confirms the upward move, indicating that buyers have overcome resistance. In descending triangles, lower highs press against a support level, and a breakout to the downside with high volume shows that sellers have taken control. Symmetrical triangles can break out in either direction, and volume helps validate the direction of the breakout. Another helpful pattern is the rectangle, where price moves within a horizontal range, forming clear levels of support and resistance. When the price breaks out of the rectangle with high volume, it is more likely to continue moving in that direction. Likewise, flag and pennant patterns also signal continuation after a strong trend, with a breakout accompanied by high volume reinforcing the strength of the trend. On the other hand, if a breakout happens with low volume, it can be suspicious. These low volume breakouts are often what we call false breakouts, where the price ends up reversing back into its previous range. This can trap traders who entered too early and did not wait for proper volume confirmation. False breakouts can be frustrating, and they often occur in low-interest market environments where the price movement lacks solid support from buyers or sellers. This is why watching for a significant increase in volume at the point of breakout is crucial for distinguishing between a real breakout and a false one. Another really useful way to use volume is to spot reversals. One key signal for a reversal is when there is a volume spike at the top of an uptrend or the bottom of a downtrend. If you see a sudden increase in volume near these levels, it can signal a change is coming. This volume spike might mean the market is exhausted and that the trend could be about to change direction. There is also something called volume divergence, which can help spot potential reversals. Volume divergence happens when the price is moving in one direction, but volume is decreasing. For instance, if a stock is climbing, but volume is dropping, it may mean that the trend is losing strength. This could mean that a reversal is on the horizon. Now let us talk about some common volume indicators and how to use them. One of the most popular is called on-balance volume. On-balance volume is an indicator that adds volume on days when the price goes up and subtracts volume on days when the price goes down. It helps confirm the strength of a trend. If on-balance volume is rising along with the price, the trend is strong and likely to continue. If on-balance volume starts to move differently from the price, it might mean that the trend is weakening, indicating a possible reversal. When a divergence occurs between on-balance volume and price, such as when price continues to rise but on-balance volume starts to fall, this can be a signal that buying momentum is fading and that a trend change may be imminent. Another useful chart pattern in combination with on-balance volume is the support and resistance breakout. For example, if price breaks above a resistance level while on-balance volume shows a significant upward move, it confirms strong buying pressure and increases the likelihood of a sustained breakout. Conversely, if price breaks below support and on-balance volume is also decreasing, it is a sign of strong selling pressure and likely continuation of the downtrend. Additionally, on-balance volume can be particularly helpful when analyzing accumulation or distribution phases. During accumulation, the price may move sideways while on-balance volume steadily increases, suggesting that larger market players are buying without causing dramatic price movement. In contrast, during distribution, the price may stay in a range while on-balance volume declines, indicating that smart money is quietly exiting positions. To summarize, on-balance volume is a great tool for identifying whether price trends are backed by solid volume. It provides an added layer of insight when analyzing chart patterns and helps distinguish between genuine moves and potential false signals. Another popular volume indicator is the volume-weighted average price. The volume-weighted average price shows the average price of an asset weighted by volume. This can help you see if the price is overvalued or undervalued compared to where most of the trading has taken place. Many traders use the volume-weighted average price to guide their entries and exits. There is also something called the volume oscillator. The volume oscillator measures the difference between two volume moving averages. This helps you spot changes in momentum. When the oscillator is rising, it means that volume is increasing. When it falls, it suggests that interest is starting to decline. Let us discuss some trading strategies using the volume indicator. The first strategy is using volume to confirm trends. When trading in an uptrend, only enter a trade when you see increasing volume. This confirms that the move is backed by strong buying and that it is more likely to continue. Another strategy is to trade breakouts based on volume. You want to enter trades when the price breaks key levels of support or resistance with high volume. This confirms that the breakout is more likely to continue because there is strong participation from the market. The third strategy is reversal trading. Look for volume spikes at the end of a trend. If you are in a long position and you see a volume spike during a strong rally, it might be time to lock in profits. Volume spikes often mean that a trend is coming to an end and that a reversal might be on the way. Now let us talk about using the volume indicator for risk management. When setting stop losses, it is important to consider using volume support and resistance levels, as these can help provide stronger and more reliable positioning for your trades. For an uptrend, place your stop loss just below key volume support levels. This ensures that if the price starts dropping and breaks through the volume supported zone, it is likely a genuine reversal and not just a minor fluctuation. In a downtrend, place your stop loss above volume resistance levels. This will help protect your position if the price starts moving upwards and breaks through the resistance level backed by volume, indicating a potential reversal. You can also use volume to determine when the market is weakening. If volume starts to decline significantly during an ongoing trend, it can signal that the trend may be losing strength. This is an ideal time to move stop losses closer to the current price in order to protect profits or minimize losses. This way, if the volume suddenly drops or the trend weakens, you are protected. By combining volume with traditional support and resistance levels, you can create a more effective risk management plan that accounts for the true market interest behind price movements. Another important point for risk management is sizing positions based on volume. Take larger positions when volume confirms the trend. Reduce your position size when volume is low. If volume is weak, the price movement might not last, so it is better to be cautious. Your exit strategy should also involve volume. When trading breakouts or trends, watch for volume to start decreasing as a sign to exit the trade. If volume drops, it suggests that the move might be losing momentum. This is a good time to take profits or reduce your exposure. Next, let us talk about some common mistakes to avoid. One big mistake is ignoring volume in breakouts. Do not enter a trade on a breakout if the volume is low. Low volume breakouts often fail and reverse. This can trap traders who jump in too early. Always wait for volume confirmation. Another mistake is overtrading based on volume spikes. Not every spike in volume means that a trend will reverse. Make sure you use volume alongside other technical indicators so you do not get caught in false signals. Another common pitfall is misreading volume in ranges. During sideways, markets' volume can be misleading. Wait for a clear trend or breakout confirmation before acting on volume data if the market is range-bound. Let us talk about combining volume with other indicators. Moving averages work really well with volume. You can use them to confirm trends. Combine them with volume to make sure that price movements are supported by enough market activity. For example, if the price is above a rising moving average and volume is also increasing, this is a strong signal of a continuing uptrend. On the other hand, if the price is below a declining moving average and volume is rising, it confirms a strong downtrend. The moving average crossover strategy can also be enhanced by adding volume analysis. When a shorter-term moving average crosses above a longer-term moving average on increasing volume, it indicates a high probability bullish signal. You can also pair the relative strength index with volume to spot overbought or oversold conditions. If the price hits an extreme level on the relative strength index and volume spikes, it is a stronger signal for a reversal. For instance, when the relative strength index is in the overbought zone and there is a volume spike, it suggests that the asset might be due for a pullback, as the high volume shows that the buyers could be exhausting their momentum. Similarly, if the relative strength index is in the oversold zone and there is a surge in volume, it indicates that selling pressure might be overextended and a rebound is likely. Another great combination is volume with Bollinger Bands. When the price breaks through a Bollinger Band with high volume, it is more likely that the move will continue. The key with Bollinger Bands is to watch for periods of contraction, known as the squeeze, where the bands narrow. During these periods, volume often declines, indicating reduced volatility. A breakout from this low volatility range, especially with a spike in volume, is a powerful signal that a significant move is starting. For example, if the price breaks above the upper Bollinger Band with high volume, it confirms a bullish breakout, while a break below the lower band with high volume signals a bearish move. Volume can also be paired with other indicators like the moving average convergence, divergence, MACD. MACD is a trend following momentum indicator that shows the relationship between two moving averages of a security's price. When combined with volume, MACD crossovers become even more meaningful. For instance, when the MACD line crosses above the signal line and is accompanied by increasing volume, it is a strong bullish signal. On the contrary, if the MACD line crosses below the signal line and volume is also increasing, it confirms bearish momentum. Additionally, combining volume with Fibonacci retracement levels can provide insights into potential reversal zones. When the price approaches a Fibonacci level with a noticeable change in volume, it can provide an early signal of whether the level will hold or be broken. If the price pulls back to a Fibonacci retracement level and volume spikes, it may indicate that buyers are stepping in to support the price, making a bounce more likely. All in all, combining volume with other technical indicators helps traders gain a deeper understanding of market movements and increases the accuracy of their predictions. Volume acts as the confirmation tool that validates the signals provided by these other indicators, making trading decisions more reliable. Now let us recap what we have talked about today. The volume indicator helps you measure the strength of market moves. It helps you confirm trends, and it helps you identify key moments like breakouts and reversals. Use volume to confirm your trades. Watch for high volume breakouts, and pay attention to volume spikes to spot reversals before they happen. Volume is one of the most important tools you can use to understand the market. With some practice and the right strategies, you can use volume to improve your decision making and find more profitable trades. Keep working on your skills and you will see how the volume indicator can make a real difference in your trading success. If you have questions or thoughts about what we talked about today, feel free to share them. Let us keep learning together and make the most of these tools.